Welcome to the Grow Your Business and Grow Your Wealth podcast with Gary Heldt. Gary is an expert in helping business owners put together a plan that will provide a better future for their businesses, themselves, and their families. On the podcast, Gary interviews other professionals who share his vision, and together they share secrets and strategies any business owner can use to build a better financial foundation for your business and your life.
Welcome back to the podcast. This week, my guest is Barry Dyke, and he is the president of Castle Asset Management, a fiduciary advisory firm specializing in holistic macroeconomic financial planning. With more than 40 years of experience, Barry is known for his bold, contrarian perspective on wealth, retirement, and the financial industry. Welcome, Barry.
Thanks so much for having me, Gary. It's great to see you this morning,
Great. So, Barry, what made you decide to get into financial advising?
It's a strange story, Gary. I've always been an entrepreneur. I had my first business when I was a kid, around 14 years old, mowing lawns, and actually took off. Actually made money doing that, and because at the time I was playing hockey, my father says, "You want hockey equipment? You gotta pay for it, and you gotta pay for your time." So, in any event, I had really great parents and great mentors, and so I always had that bug in me. And I believe it or not, I was involved I worked for RCA Global Systems years ago, and I was one of the top, salesmen in the country, believe it or not, around 23, 24. And then I get involved into high tech, believe it or not. I ended up selling parts to missiles and infrared missiles and things like that. And I travel around the country, down Maryland, that area, because, the Beltway and California and Texas and Florida and those types of things. And it was a long story, but it didn't end well, but some businesses do. And so I wanted to get into being self-employed. I did, at the time it was around 83, Gary, and there was really wasn't a lot of jobs. And I always wanted to be self-employed, so I started to go actually selling insurance, and then becoming rookie of the year for Prudential. This is like 40 years ago, if you will. But then I got into I had a pension consulting business and a health and welfare and a third-party administrator, and I still do pension consulting to this day. But so I've been very, very blessed. But around 16, 17 years ago, I wrote my first book called The Pirates of Manhattan, which kind of put me on the map. And I explained why most mutual funds and ETFs really, they don't work. Okay. And I exposed where the banks put their money in, and that type of thing. So that was 16, 17 years ago. So I've subsequently released 4 other books, and I just finished my 5th book, and the 6th will be coming shortly thereafter. And Wall Street and the banks hate me, so I must be doing something right.
Right. So, Barry, you mentioned mutual funds and ETFs, and a lot of people, I'm going to say, blindly trust an advisor who's telling them to get into these. Can you explain, what a mutual fund is versus an ETF?
Sure. Well, mutual fund is generally just a pooled investment, consisting of, various stocks. It could be as many as 500 stocks, like the S&P 500, which would be an index fund, or it could be an actively managed fund, which is there's a big one down by UT. Road Price is a big active manager. Mm-hmm. Or you can use exchange traded funds, which are generally indexes of an industry, whether it be like energy or, say, precious metals, or who knows, private credit, whatever the case may be. So generally those are the types of the funds. Now, I'm not, I'm pro market, Gary, but the whole thing is, when you understand it, what I understand is that so many of these people don't understand is that it's the asset manager who makes all the money on this stuff, mm-hmm. on the spread and management fees and so forth. And so I've done a lot of research on and the first book I did was called this book called The Pirates of Manhattan. I don't know if you can see it or whatever, but
yep.
And that came out, and this was when there's all these huge mutual fund scandals, and so now we're seeing the latest scandals with private credit, which a lot of these are in business development companies, which are kind of in the same church, if you will. So the business owner who you're serving really has to be more careful than ever to have a good retirement plan. Or we prior to this call, we talked about getting exit strategy. So retirement plan is an important part as an exit strategy for the employer because they need liquidity, and if you do it correctly, it can be really a great asset. Excuse me, and I'll give a great example. I just did a pretty big cash balance plan for a dental practice, and very successful dental practice, but they had a lot of real estate assets and other things, but there was really no liquidity in it. So we put a cash balance plan in, and so this business owner will have probably about 2-3 million on top of the other assets. So you have to be really careful because the system is rigged against the consumer or the business owner, and it's very difficult. And I think you would agree, if you have business owners, they're obsessed running their own business, whether it be a plumbing business or a what have you, anything. They have to be so obsessed to stay in business that it's very difficult for them to understand what's really going on. So I try to put sunlight into these things. And what I've also done, Gary, is I've studied all the best retirement systems in the world. And if you such as the Netherlands or Israel, Iceland, or the Norwegian countries, and I found that all the best retirement systems are annuity based, or they're guaranteed based. And now there's a survey called Mercer Global Pension Index, which measures all the top 30 retirement plans in the world. And I have a question for you, Gary. Now, the U.S. is the #1 economy in the world, but where do you think we stand in terms of retirement preparedness?
It's going to be very, very low.
Yeah, I hate to say it for your listeners, but we're number 30 in the top 30.
Yeah.
I mean, even Mexico is right better than us.
Yeah.
I mean, but by a significant margin. And the reason is because the retirement system plan today, if it's a 401k, is kind of like me driving up to your driveway, Gary, and dumping all the parts to an automobile onto your driveway and say, Gary, put the car together. Mm-hmm. And that's the way the systems are in the United States today. And that's why Wall Street likes it. They want you to be confused. They want you to be beholden to them. We talk about language, things like that. So this is what they're really doing to the consumer today. And you're in Maryland, so I don't have to tell you about lobbying and everything. They're the folks that control everything. I mean, it's just, right. It's not the consumer, okay? It's the asset managers, and now, which is tragic, I don't know if you've been following this, is they want to push in alternative investments into 401ks, which are things like private credit, private equity, hedge funds, distressed debt, and what have you, which is like giving a 6-year-old a circular saw to play with,
right?
And so I think now more than ever, people in the American public really need to say, hey, what really works? And I'm not against the market. I'm a big believer in capitalists. We manage a good amount of money for people, but so when it comes to retirement, you want to have someone with seat belts and guarantees and guardrails, but they want to the asset managers want to put this stuff in because they're dying from the investments they have in public pension plans. The public pension plans, which, by the way, are the biggest sources of capital for Wall Street. You're in Maryland, for instance, or if you're, say, in California, or CalPERS or CalSTRS of Florida, these are the biggest sources of capital, and they're kind of sick of this private equity, and so they're looking to get into new markets. So they want to put people into people's investment into this stuff, and to me, it's just dangerous and it's morally wrong. But there are good solutions, and with guarantees, and and I'll always be happy to talk to anyone. But yeah, so it's very difficult for the consumer or the
Yeah.
business owner. Would you agree?
Yeah. Yeah. What are some of the big risks that are in retirement plans that people don't know about?
Well, a huge one is sequence of returns risk. In other words, as we approach, that's like with a 5-year window between now and retirement, where if you have a significant loss, people can Google sequence of returns risk, is that you one of your biggest asset risks, and if you particularly if you have something like a 401k, is that what's going to happen if you have a market drop. Now, I hate to be a pessimist, but we are in the middle of another correction, and so what could happen is that people could have a huge loss for it's like a 5-year window right prior to the retirement. So that's a big risk that people face. And then also just you want to have something which is really liquid. So that I think one of the biggest for people if they're near retirement is sequence of returns risk. And Wall Street and the banks and the asset managers, they don't want to talk to you about this because, um, but if you look at the best retirement systems in the world, and I have, they're all based upon guarantees.
Yeah. Yeah. So, you talk about, Wall Street and everything. What is how do they continue to benefit at our expense, I guess, is a question.
Well, yeah, you have to understand the banking system, and this is one, and this is why I write books. And by the way, I just finished up my latest book, and that'll be coming out within 60 days. So it's going to be kind of it's going to be a big expose. Let me just say, a big expose on the largest asset manager in the world. So the thing is, you have to understand that during the financial crisis, we, the taxpayer, had to put over 16 trillion, and I'm not lying this, okay? And I have the backup. I got it actually from the government accounting office that we had to put 16 trillion into the banking system because of the blowback from the subprime mortgage and so forth. My point is, I'm a small business person. You're a small business person. If we have a problem, we have no safety net. Gary, would you agree? So the thing is, the bank screwed up. I mean, last time it was subprime mortgages. This time it'd probably be, private equity, private credit primarily. But so the thing is that they get bailed out, and so what I'm saying is these are, people have to understand this. So you want to have guarantees. And so irony of the whole thing is what I discovered is that the best retirement systems are guarantees, and the best things to use are some of the mutually owned insurance companies and fraternal companies because they're not over leveraged, because there's still a tremendous amount of debt in the system. And if you study history from the Roman Empire to the financial crisis in 2008 or to the dot-com meltdown, they're all involved with significant amounts of debt and leverage in the banking system. And it's still there. I think it's probably worse than ever. But I think this is what people need to understand is that they should have some guarantees or seatbelts around their money because of the excessive leverage in the system. And if you look at from a balance sheet perspective, and I've been very blessed because I have become acquainted and actually personal friends of mine now, some of the best experts in the world in this stuff. If you look at some of the insurance companies, they're the safest places to be. But people think it's crazy, but I'm not making this up. Now, what happened, Gary, and this is true to this day, and this is how I got with this book here, the first Pirates book. This is how I don't know if you can see it, whatever. But I was the guy who buys the most guaranteed life insurance and annuity business more than anybody, Gary.
No idea.
Where do you deposit your checks?
Mm.
The banks.
Yep.
So, matter of fact, I'd be delighted. I'll send you copies of my book. So to this day, and I would testify in court or in Congress in front of it because I've actually gone to look at the filings. They're making it more difficult to find now, but even to this day, your major banks like JP Morgan Chase or Wells Fargo or Citigroup or Bank of America, they all have more money invested in life insurance and cash value life insurance than they do in even real estate. So they're using it really as a they're not putting billions of dollars in because it's a bad place to be. They're doing it, and actually, I have the Federal Reserve guidelines to back up as an investment. To this day, Gary, this is all true, and I've documented all this stuff. So this is the craziness what you're seeing. So see, because the fact of the matter is, regulators won't even let banks invest into equities because they're too volatile. Now they make a ton of money,
right?
Okay, asset management, they're all one wealth division because that's an annuity income stream for them. But for themselves, for their own personal account, the regulators first of all won't let them put money into their own reserves. They won't. It's verboten, and secondly, they're doing this for very good reasons because people don't understand the bank leverage. Now, do you want to get into that at all, or how banks lever what caused the financial crisis?
Sure.
Well, when you say you go to a local bank down the street, Gary, and say you have $10,000 in a bank, and it's your money, and they're considered your account, so they consider their asset, and they give you interest on that as loaning. How much do you think of your $10,000, Gary, that the bank can lend out to the public, and they lend out some of it, all of it, or more? But what do you think?
My guess is probably more than I have in there.
Just take a guess. They can lend
125%. Really?
They can actually, prior to 2020, before the repo market froze up, Gary, they could legally lend out 9 times your money.
Wow.
Okay. And since the repo market froze up in 2020, in September 2020, there is no requirement. So a bank can lend out a limited amounts of money on your deposit. It's called fraction. Anyone who doesn't believe me, Google fractional reserve lending. That explains it. So banks, by very nature, they're very, very levered. And I would say if 1 in 100 people understand that, there'd be a lot. But so banks are very, very levered by nature. And this is a problem. This is what happened in 2008. And is that the banks are very levered. Bear Stearns, Lehman Brothers, Merrill Lynch, Morgan Stanley, they were levered not just 10 to 1, but they were levered 30 to 1. Deutsche Bank was probably the worst. They were levered at 60 to 1. And so they're very, very levered. They create money out of thin air, but if you don't pay back the money they create out of thin air, they repossess your assets.
Right.
So this is all true. So I've researched this very well. So if you put your money into an insurance company, okay, in a right one, and I also caution people, you have to be really prudent. You have to stick with the mutual fraternal, because if it's a Wall Street backed company, you want to run from them, but that's another story, but it's coming out in the next book. But they have to reserve every dollar. So if I have $1 in an insurance company, a good New York company, some of the other companies, and there's still some good ones left, they have to account for every dollar. But if I'm putting $1 into a bank, or say you're near Delaware, right?
Yep.
Which is kind of where a lot of the credit card companies are most of them are headquartered. They're lending money out, 20-30% interest, and and they're doing this. So you have to really look things structurally. And I'm not against the market, but we're talking about this retirement plan, and people want to have peace of mind when it comes to this time. And so God's gifted me, and I understand this stuff. So if I can't be of help if I keep it up here. So that's why I write books.
Right. So Barry, you've covered a lot of stuff. You've brought out a lot of things that I don't think a lot of the listeners think about. When it comes to where we invest and how we invest. What question did I not ask you wish I had?
Do I think there's going to be another financial crisis?
Okay. Do you think it's going to be another financial crisis right now?
Yeah, it's begun. I don't think it's. I hope it's not going to be like 2008. But I don't know if you have children, whatever. But I think one of the things where I live in New Hampshire, I live in a beautiful area in New Hampshire, and I talk to people around the country. But I think people don't understand why is it so bloody expensive to buy like a home. I have children and grandchildren now, and some I'm very blessed they're doing pretty well. But the cost of housing is sky high now, and one of the reasons is because the system is there's so much inflation in it, and so I think people have to be more prudent than ever in financial decisions because I think they will bail out the banks, they will bail out corporate America, but they won't bail out the average person, small business person when the next financial crisis comes. And I believe it's somewhat happening already. And the canary in the coal mine being the private credit, which is going through a lot of turmoil. And so that's and then I also think we're in another bubble because of the AI. I'm all for it. I love artificial intelligence, Gary, but I'm concerned about it because you see Meta, which is which is Facebook, that's spending all this money with Blue Owl, and which was one of these companies that were in the private credit crunch. But you also have to be careful because people don't want to talk about that Zuckerberg and Meta, they invested $80 billion, Gary, into the metaverse, with seeing people, which is kind of cool. It's in the technology, but essentially, Facebook, they lost $80 billion on that. And there's a great article in the New York Times that covers this. So I think you have to be more cautious than ever, because Wall Street's or the bank's going to look out for them. They're not going to look out for the average consumer, the small business person. Is my point. So you have to be self-reliant, which is one of the things which I think has made America great. So I think you got to be more self-reliant than ever, and I think you got to really question even a lot of asset managers, because they want to make money with assets under management. So I think you just got to be really, really. You have to question some of this stuff.
Right. So Barry, if people want to reach out to you when they want to learn more about you, they want to find your books, where can they go?
Sure. So the best thing is go to barrymajamesdyke.com. They can get my books there. And also too, even if they don't buy the books, you can sign up on my mailing list, and they'll definitely want to be in the mailing list because of the book which I'm about to release within 60 days, Gary. It's done. Which will get into which I'm talking about what the world's largest asset manager is doing, and so so I really want to help people, and also there's information on the website which I give out there to the public, which explains things like private equity and because people really don't know, so I put together like a glossary of terms. So it's all there for free of charge. So I'm really just trying to help the next generation because I'm a grandfather now, and I really want to leave things better for the next generation.
Great, great. Hey, Barry, I appreciate your time today. I'm sure the listeners got a lot out of this and looking forward to reading your next book that's coming out.
All right. Thanks so much, Gary.
Great. Hey, this week my guest was Barry Dyke, and he's the president of Castle Asset Management. I'll see you guys next week.